Good afternoon. Welcome to the TheoTrade afternoon video. I am Blake Young. Today is November 7th, 2024, and we're going to talk about the Fed rate cut as well as some inflation trade opportunities. To start with, let's just deal right out the chute with the discussion of what the Federal Reserve statement was. And I'm going to oversimplify this and go very quickly, but it's easy to do because this is one of the smallest statements the Fed has released around a rate cut. They basically say, top line, top paragraph, recent indicators suggest that economic activity has continued to expand at a solid pace. Since early in the year, labor market conditions have generally eased, and the unemployment rate has moved up but remains low. Inflation has made progress towards the committee's 2% objective but remains somewhat elevated. That first paragraph is wrought with problems. Number one, the Fed is saying that there's economic activity and has continued to expand at a solid pace. If the economy is growing at a solid pace, why are we cutting rates? What is it that they see down the road that is a concern? I think it is the very next line. The labor market conditions are easing. I believe they're looking further down the road and seeing a bigger problem. But here's the bigger problem in addition to all that. They see something coming that they need to start prepping for and start to front run and protect the economy. And so despite the fact that we have lots of growth and that we're on track to get to the 2% objective, they're saying the labor market conditions are enough to make us be concerned. And as we're looking at the inflation, they're saying it's made progress towards the committee's 2% objective, but remains somewhat elevated. They're acknowledging that it's made progress, but notice they didn't say it's made progress to our goal, but it remains at 3.2%, at least the way we look at it. So the Fed is admitting that the rates are higher, but they're trying to hide it in the fact that they're saying 2% as their goal. That goal has nothing to do with the current state. The goal is a number. The current state is 3.2%. So we still have inflation. The PCE number they look at is still hot. It is still high. It is still not showing signs of weakness. So here we are in a quandary. We are cutting rates, which is done to stimulate economic activity and make money more readily available. We're doing that, which will cause inflation, but inflation is not to their target. They're saying we're growing, so we don't have reason to cut rates. They're saying we haven't reached our target, so they have no reason to cut rates, but they're cutting rates, which tells me they are a lot more concerned about jobs data and the economy. And again, this is the entire thing. You are seeing the entire statement. Down here, it's just telling you who the voters are down at the bottom. That's it. That is the entire statement that they made. And they restate that it's all about keeping the jobs where it is and inflation where it is by restating right through there again that we're cutting the rates, and the committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. The problem is the rate cut is not focusing on inflation. It is only focusing on the jobs information, the employment. So that's what we're dealing with right now. That's what we're seeing. And the proof is in the pudding. If we look back to September at the jobs data, you can see job opening labor turnover survey fell one of the biggest drops. In the previous month's numbers were revised lower. Non-farm payroll missed. Non-farm payroll from the ADP and the Fed missed. And it just was terrible. And that's when they cut rates before. So they saw the jobs data and it was a total miss. And not great. If you look out into November, jobs opening and labor turnover survey got worse. At the peak, we had over 12 million job openings. We now have 7 million job openings, while non-farm payroll was revised lower last month, missed expectations, and came in at 12,000 jobs. That 12,000 jobs, the problem with that 12,000 jobs is any number below about 200,000 is within the margin of error because it's a survey and they really won't know until the next time period. We revised the last month again down to 223, only expected 106, and we came in at 12,000. I would anticipate that this number is probably truly negative. And so the jobs data, we are seeing more losses of jobs, net decline, and this does not adjust for immigration. This does not adjust for aging population, those leaving the workforce or going into the workforce. It is simply a net jobs. How many jobs were created? Who got a job? Who lost a job? And so that 12,000 is likely considered a net negative. And so I believe that's what they're looking at. And it's kind of the attitude of we don't care about the inflation right now. We're much more concerned about employment. And you can even see from one of the statements down here under a report, 1 or 2 bad months of inflation won't change the process. They're acknowledging, admitting that this is going to create higher inflation numbers. The inflation numbers are back on the rise. When you look at core, it never fell. We do not have this on track. We are not hitting the numbers. We are more concerned about jobs. So if that's the case, that means we're going to have inflation. But if jobs are declining, this is setting up for that scary word, stagflation. We are dealing with stagflation and inflationary pressures, and that's what we need to be focused on going into the end of the year and into next quarter. So to look at that, I'm going to look at a couple of key things. Primarily bonds, as they are going to tell us what we're doing as far as inflation-wise and interest rate-wise, and kind of defense-wise, how are we protecting ourselves economically. And I'm going to look at substitution stocks, and I'll show you what I mean by that here in just a minute. So the 10-year Treasury yield has continued to rise. This is a response to bond prices versus existing interest rates. And so this is just a summation or a current cash market or reading on what the difference is between bond prices and interest rates that they're issued at. And it gives you a quick sentiment of how we're moving. Now this gap up, close down, gap up, close down, this is showing that we may be putting in a top in interest rates. Today's move down is pricing that quarter point. This move was pricing in future rate cuts back in June, July, August, because we kept talking about it. And then when they cut in September, we unwound that. And so the fact that we cut today and we expect 1 or 2 cuts in December, I would anticipate this is going to put the pressure to the downside for yields, that we're going to see lower costs to borrow. Now, whether that means money makes it into the markets, that's to be seen. The inverse should be true with bonds, and this is what we're going to look at, the ZN. The ZN would be an opportunity to be looking at this as a bounce at a supply area that we've defended before. Today is a very large bullish day inside a very large bearish day. So if we can get through this high, that would be an indication to me that we've had a solid bounce and recovery from a technical perspective. And I'm looking at bond prices to rally up into October levels and possibly even all the way back into September levels. That would be further support of bonds moving higher and yields going lower, and once again, inflationary pressures. In response today, the top performing sectors and the top performing stocks and the top performing commodities were copper, which is a growth and demand and inflation indicator, gold, which is a growth and demand and inflation indicator, technology, which is a big borrower of money, and the small caps, and real estate. Lower rates are going to theoretically mean more demand for real estate. And we could simply trade technology with this breakout. We're going to push back up to the 52-week high. If we break through the 52-week high, we could be running another 10 or 15% by the end of the year. I need it to clear this 52-week high, and I'm not going to chase it into technology. So instead, I want to talk about substitution. One area that is hard to track is substitution in inflation. What does substitution mean? Substitution means that instead of going out to eat at a restaurant, I will eat at home. If the demand for eating out at the restaurant declines, maybe the prices don't rise even though inflation is there. So you're not going to see the inflation in the restaurants because we're not going out to eat. Demand is decreased because we're substituting eating at home. You could say the same thing. Instead of buying steak, you buy a hamburger. Instead of going to the movies, you do a subscription service for $9 a month and you watch movies from home instead of going to AMC. These are all substitution type plays. And I think what we're going to see is, like we already have this year, stocks like Nike are continuing to sell off. The brand names are continuing to fade. And I brought this up during the main room chat today, and I'm just sharing it with those that are maybe not in the main chat and haven't joined us at TheoTrade.com yet. But as you're looking at this, Nike is continuing to make lower highs, lower lows, lower highs, lower lows. This downtrend is pretty solid. Does that mean that we're not buying retail clothing? No. It means that we're substituting. We're finding things that are cheaper. Where else are we buying our clothes? If you're like many people at my age, the men, we buy Kirkland, right? We buy Costco clothing. Costco pants work. Or we go over and say, instead, I'm going to buy the brand names, but I'm going to buy them at TJ Maxx or TJX stores. And we're seeing that TJ Maxx is near its 52-week high. It's bouncing. Today is a solid continuation higher ahead of earnings. I think they're going to beat earnings. I think they have a better shot at breaking through the 52-week high here. Stores like Ross Dress for Less, Ross Stores. If you look here, we've bounced off support, the risk is low, and the upside is huge as we substitute buying it from the name brand retailers and go to the discount retailers like ROST stores. A move from 142 to 160, 160 to 163 could be a $20 move on a stock, and the risk might be $3. So you might be able to get 5 to 1, 6 to 1, 7 to 1 reward risk on these discount stores. And as we go into the holiday season, we expect these kind of stocks to continue to run. And for a more diversified look, you might take a look at retail sector ETFs, XRT. Many people are already aware of this, but just to highlight and remind you that the retail sector, retail stores, generally get 80 to 85% of all total gross sales in the last quarter of the year versus the remainder of the year. So 20% happens in 3 quarters and 80% happens in this last quarter. This is the time where the retail stores really shine, is where they do their best. I still think there will be substitution, and we're going to be focusing on discount prices, which means we may want to go look at Walmart. We may want to go look at Kroger, which Kroger, for those of you that are in different parts of the country, that would be Smith's, Kroger, Fred Meyer, Harris Teeter, and some other store brands that would be represented in your specific regions. But these are where we can also go to the Smith's Supercenter, the Fred Meyer Supercenter. And we are in these trades, XRT and KR, and seeing new record highs. This is likely to be sustained as we look to buy cheaper goods, cheaper products, substitute products, and avoiding the higher cost brand names while still buying things, gifts, etc. for the holiday season. Costco is pushing up to its 52-week high and a breakthrough 922. I expect this to move approximately $50 to $60 higher, and I'm looking for about another 5% increase in stocks like Costco. And these are the ones that tend to survive and do really well during stagflation or inflationary markets. We still look for the discount and value. Doesn't mean we stop buying. It means we start buying value and discounts. And these are the ones that I'm looking for today that really already established the trend days, weeks, and months ago. But now I'm using today's cut in interest rates to confirm as a catalyst to continue these trends in these discount areas. Now tomorrow I'll be talking more about sector rotation, business economic cycle, and industrials. We'll talk a little bit about industrials tomorrow morning in tomorrow morning's TheoTrade Live. So join us in the morning. We'll talk about some other opportunities that this market does set us up for. So regardless whether we have inflation or stagflation, where the next opportunities are, and we'll see you in the morning.